I'm sure you've heard me discuss how the infinite banking concept is not a either or, that this is an and, that we're not saying you should put all of your money in a life insurance policy or real estate or your business or the stock market, that this is an and, that you can run your money in your policy and then run it through your policy to invest in real estate, your business, or the stock market. So here we're going to show an example of how this can be used as an and in this situation we're going to discuss investing in real estate. So what we're going to do is we're going to compare two scenarios. One in buying a rental property in cash and there's no mortgage, and then, well, let's compare that to what if I had $100,000 in cash value and I borrowed against my cash value and paid for the property in full. Now I am going to have to pay myself back. We're not going to steal the peas, but now I have a mortgage payment. Which way am I going to be ahead at the end of the day? So that's what we're going to look at today. So here we have a real estate calculator. In this example, what we're going to do is we're going to use a property of $100,000. We're not going to go into closing costs and realtor fees right now because we're just comparing two different scenarios. So as long as they both have the same cost, we're going to have a relative result. Just for depreciation, because I'm a CPA, let's say that the land is worth $10,000. Let's add a few expenses in here. So let's say we have property tax of $75 a month and insurance, say $35. With all these other fees, again, since we're comparing two different scenarios, as long as they have the same expenses, it's going to be the same to each one. Say we have rental income of $1,000 a month, and you can see here, as of now, our rate of return is 10.78, which sounds great, but we forgot about your partner, Uncle Sam. So let's say that we're in the 33% tax bracket. What impact it? Oof! Wow, that makes that rate of return go down even smaller. Now we're going to have a capital gains rate. We're going to use 25%. For many of you, if your income married is over $250,000, you're actually going to pay some additional Medicare tax of additional 3%. But let's just leave that out of there. Let's look at 10 years or 120 months. And let's say that it's going to appreciate 2% a year. Okay, so this is what it would look like. We would have a monthly cash flow of $596. The future value of the property would be $122. We will have to pay a capital gains tax. So we'd have a net out of $116,590. So let's just add that up here. We're going to make a note. Let's call this scenario cash. Okay, so monthly, we have the $596, which is right here, the monthly cash flow, 596 times 120 is 71,520, and the net cash out right here is going to be the appreciated property minus your taxes. So that's 116,590. Okay, now we need to subtract out what you invested in this. So we have to subtract out a negative 100,000 because that's what you contributed to start this business. Oops, I'm not a great speller. So our total return is 88110. Oop. 88110. And just so you know, I did go ahead and to save time on this video, so you didn't have to see me add these up. I went ahead and already added these up. So at the end of the day, your investment of $100,000 after 10 years and the cash flow and the appreciation, your total return would be 88,110. Okay, so now let's see what it would look like if we use the IBC method. So let's lower this. Okay. So now we're going to take a loan, a policy loan for $100,000. Now this loan is going to be against our cash value, and companies are ranging between 5 and 8%, but most of my clients are using companies that have 5. And let's amortize this over 360 for like a typical mortgage. So a couple things happened here. One, now we have a monthly payment of $537. So now our monthly cash flow is less than it was before. In addition, you're going to see that the rate of return now is NA. And I'm sure some of you are asking why that is. And the reason being is since we borrowed 100% for the purchase price, we didn't invest any dollars ourselves. It was all a loan. So there's no way to calculate the rate of return divided by our zero amount of investment. But again, that's one of the issues with focusing on rates of return. But now let's go ahead and add this up. So in the IBC method, our monthly cash flow went down to 185. Times 120. So this is 22,200. Our net cash out. Our net cash out is 35,248. Now, take a look here. We can see that our future value of the property is going to be the same, okay? But now we have a loan balance. But as we've been making the payments, some of that's principal, some of that's interest. So our loan balance went from 100 down to 81. We subtract that out from the total proceeds, and that's why that number is so much smaller. And right now you're probably saying, well, this doesn't really look that much better, Anthony. But remember where we got this money is that we borrowed the money against your policy, not from your policy. So that $100,000 that you have in your policy, isn't that still compounding at 4%? So don't we need to take that into account? So your $100,000 at 4% is $148,000. So the growth in there is 48,024. So I just subtracted out the 100,000 that we started with, so that is a gain. So now, drum roll please. We add this up, and it's 105,472. That is an improvement of 17,362, or we've improved your results by 20%. Now, a few points I want to make up. I want to point out. Some of you may be saying, well, why would I borrow at 5 if I can get a loan for less than that from a bank? And in this situation, maybe you should. Just keep in mind that if you do that, you're going to have to put some sort of a down payment, right? So what if instead of this $100,000 property, maybe if you've got $100,000 and this is really over 10 properties. So this could just be the example of your down payment. The key thing here is that when you run your money through your policy, it's continuing to compound even though you have used it. Now, also keep in mind, if you do borrow from an outside bank, is that you are required to make that payment every single month. So whether your tenants are in there and paying rent or not, when you are the bank, if you have a few rough months, couldn't you stop payments for a few months until you get that tenant in there? Of course, working with us, we're going to make sure that you pay yourself back, but the key thing is that you have that flexibility. In addition, if you make a payment to somebody else's bank and you need to use that money again, you're going to have to go and re-qualify and pay additional loan fees to get that equity out. When you have this in your policy, as you know, there is no application, and every time you make a payment, that money goes in your policy so you can use that again. So there's a lot more to it than just focus on the numbers. But the bottom line here, I think that this validates, I like to say that we do the math, that buying rental property, if that's what you want to do, that's great. And by running it through using the infinite banking concept is only going to improve your results. And in this case, we proved it by 17,000 or 20%. Now, are you working any harder? Have we changed the cash flow at all? Or are you taking on any risk? All we've done is taken what you've been doing and have just improved it. And so in this example, we use a rental property, but couldn't this be the same thing as if this was maybe buying a franchise or maybe investing in the stock market or any other sort of opportunity? Again, the infinite banking concept is not an either or. This is an and.